Welcome back. I'm Brandon, also known as the HBAR Bull. I do some work for the HBAR Foundation, but for this interview, the opinions expressed are just those of my guest and I, not the foundation. Today, I'm really excited to welcome Michal Benedykcinski, Senior Vice President with the digital asset management firm Arca. Michal, thank you so much for swinging by.
No, thank you. Thank you for having me, Brendan, and excited to address and engage here with Hedera Forum.
Yeah, I'm looking forward to it. So, to start off, can you just tell us a bit about your own background?
Of course. So I came to crypto via relatively traditional, as we like to call it, TradFi rails. Started out in investment banking. I was a longtime M&A advisor, primarily focusing on data infrastructure and kind of telecom space. So really kind of the bricks and mortars of the digital economy we know today. Subsequently, I ended up switching from sell side into a buy side, ended up joining a private equity firm where I worked subsequently on building out kind of a portfolio of assets in the infrastructure space. And while I was doing that, I started picking up an interest. My kind of area back then of focus has been data centers and kind of telecom towers. A lot of kind of geeking out on the inputs that make this internet that enables even this call work, but very quickly realized that that skill set was directly applicable to the mining space, and not mining in kind of your traditional manner, but started out effectively freelancing and advising some of the early Ethereum miners in kind of 2016
Okay.
in Europe. And that's what kind of exposed me to the magic internet money. And as I started kind of pulling on the thread, going beyond the miners, I really wanted to get involved and jump into that proverbial rabbit hole. So in 2017, I actually at the time decided to come back to grad school, come back to the States. That's why I did my undergrad after all those years in London, and started looking how to get engaged more formally in the space. And so I ended up working with a number of projects in the space, mostly kind of freelancing. Eventually ended up settling on leading corporate development for one of the offshore digital assets exchange, where I led a variety of different acquisition efforts, whether it was in a custody, asset management, hedge funds. I would say up and down the financial infrastructure stack of digital assets, which has been a kind of a great learning experience and really makes you realize how early we still are, even to this day. Subsequently to that, I ended up joining back then Hedera Hashgraph before the days of the foundation, where I helped out on the business development side, focusing again kind of on financial services, bringing USDC, the stablecoin, into the ecosystem, and several kind of adjacent efforts that would eventually kind of graduate and spring up some exciting opportunities that are coming to fruition now, which is kind of exciting to see. And as the foundation was getting launched, I also recently became a dad. And around the same
Congratulations.
time, thank you very much. Around the same time, I was thinking of spending a little bit more time with my portfolio. I have been investing as an angel in the space, and eventually wanted to spend more time with the founders building kind of the future today. And as a result, decided to join forces here with Arca and launch our new venture strategy last October.
Oh, fascinating road. And I think you went to school. I saw on LinkedIn you went to University of Pennsylvania. I'm right outside Philadelphia, so we have some ties there.
Awesome. Yeah, no, Philly is truly a city of brotherly love, and miss it every day.
Yeah, yeah. All right. So can you explain Arca's business?
Of course. So Arca has been one of the probably oldest digital assets managers in the space. And what I mean by that, have been developing a number of different strategies that now kind of comprise the family of funds that everyone knows as Arca. The first flagship fund started way back in 2018, was called the Digital Asset Fund, that to this day is the flagship fund of the family. Is primarily focused on liquid tokens, large, I would say, kind of the top 20, top 50, depending on kind of the cycle that we are in, by the market capitalization, and then fundamentally takes kind of a long duration positions in those projects driven by fundamental research. So that particular vehicle does not apply any leverage, as many of kind of our peers in the space have done historically. We've kind of learned the lesson being born in the last bear market, and so navigating it to this day. And off the back of the success of the digital asset fund, the organization started actually launching subsequent new adjacent strategies. So last October, we have launched the Ventures Fund, which I came on board to co-lead with David Nage, who was one of the early employees at Arca. That fund is primarily focused on some of the earliest investments in the digital asset space, really looking at the pre-seed and seed being kind of our typical sweet spot. We occasionally do Series A's across kind of the gamut of three, I would say, main concentration buckets when you look at our portfolio of 25 investments today. First bucket, and we can kind of dive a little bit deeper into our activity down the road. First bucket, essentially a lot of blockchain, gaming, and NFT infrastructure. We support kind of a lot of the on-chain analytics, ability to kind of query and store the data, and then one also that kind of enable the development of new, as we kind of see, tokenized culture properties. Second bucket is DeFi. Primarily kind of focusing on DeFi for the masses versus necessarily DeFi for the whales. Really how to make these new primitives accessible to all versus just a select few. And so whether it's API delivery into fintechs and neobanks that we all know and love, or ability to educate newcomers into a good financial on-chain behavior. Those are some of the investments that we like in this category. And then finally, is the kind of favorite crypto VC Web3 miscellaneous bucket, which is kind of anything that fits into the Web3 infrastructure playbook, meaning storage, social, identity, pretty much entire stack that we know and grew up in Web2, projected onto kind of the Web3 rails. And then last but not least, we've also launched earlier this year an NFT fund. And that one is, as the name suggests, focused on a very fun, exciting segment of the market that is the non-fungible tokens. And more specifically, beyond just kind of the picture profiles, sets of kind of 10,000 collections, more interesting elements such as land, variety of different kind of next generation NFTs that are coming to the market with increased utility. So that's it, Arca in a nutshell. Really kind of spanning the wide gamut from both the liquid as well as the illiquid side of investments. And so we have a pretty good readout on not only kind of the sentiment, but what works, what doesn't in the markets today.
It's good to hear. I know, we're getting more and more adults in the room, but it sounds like Arc is certainly one of those more mature enterprises.
Certainly, and even when you look at the background of the founders of Arca today, whether it's Jeff Dorman, our Chief Investment Officer, whether it's Rain Steinberg, our CEO, or Philip Yu, our General Counsel, each and every one of them had a long and storied careers in traditional finance and the securities world, knowing very well what it takes to have and take the fiduciary responsibilities to heart and internalize it and kind of mold the organization that kind of follows these best-in-class guidelines. And to that end, this is honestly what attracted me to the platform as well, is the ability to bring a proper and institutional grade management, asset management style into this young and burgeoning field of digital assets.
Good stuff. So I've recently heard Jeff Dorman, your CIO, talking about how Arca looks at layer one networks to kind of assign a value. One way is kind of looking at it like a company, the fee revenue, and looking at it like earnings, something along those lines. And another was to look at the network's infrastructure, kind of like you would value a nation. Can you elaborate a bit on this?
Absolutely, and that is a topic of everlasting conversation, even internally at Arca, as we have pretty healthy representation on both sides, viewing the world via that prism, as you indicated, Brandon, of looking at blockchains as a business, and then second camp, really looking at the blockchains as a nation. And so I'll kind of dive into both. Before I even do, maybe it's something we can also link in show notes, as this particular framework has been internally developed by one of our research analysts, Nick Hotz, and I want to definitely credit him here because he's put it way more eloquently in kind of the long form piece that I hope listeners will be able to digest after the show. But I'll kind of summarize maybe and give you the skinny of it. The premise is such that if you are looking now today at a variety of different blockchains out there, and I'm really kind of painting with a broad stroke brush here, putting in both the layer ones as well as layer twos and variety of different scalability solutions in that bucket. There is a very important and honestly very vocal camp in a space looking at blockchains being in the business of selling blocks. Probably bankless has been kind of the frontier here of pushing this. And there is very much an argument to be made that for all the advocates of blockchain as a business, you want to be able to value these networks by looking at their cash flows and the fees that they're generating on the type of activity that they're supporting. And it is much more actually the fees a feature than a bug. And by design, the not only kind of the security layer of those protocols, but more importantly, the fees are also a reflection of kind of the overall health of those economies. The more fees you generate, the greater value you accrue to effectively the underlying token and kind of the world building that is taking place in these kind of open networks. Now, this framework is fundamentally always, and even though oftentimes they don't like to admit it widely, that framework is very much pegged to taking fiat and equating whatever the fees are generated to the fiat that we all know.
Sure.
That's what effectively is kind of at the setting up that framework for that kind of a purely financial modeling analysis that this camp goes about. Now, the second point of view, and I'm probably straddling between the two. The second point of view is looking at blockchain as a nations or cities, and there have been kind of many analogies used in the past. I know Chris Dixon and even Hasim at Dragonfly have these kind of very interesting city comparisons, really talking about each and every one of these little ecosystems, little today, but eventually growing in prominence as they gather more users, as they gather more steam, bringing in the economic value, so quote unquote, the GDP of those ecosystems by supporting variety of thriving pieces of the economy. So not just one particular dApp that is generating vast majority of cash flows with the associated chains, but rather looking at providing an infrastructure to many of the different niches of the economy to emerge, whether it's the creative with NFTs and blockchain gaming, whether it's financial with a variety of DeFi. And then ultimately, you also could have fun with this model and talk about the army that each of those projects commands, because the army here, kind of in case of the proof of work networks, are typically the miners, and then in the case of proof of stake are the stakers. They are trying to keep the network secure and fend off any attacks. And so that both, I believe, merit a discussion. And I would say it is very much down to a cold and calculated approach as to where one decides to kind of value variety of different ecosystems out there and through which prism they're going to use. But I would say kind of in the top level, that is kind of the mechanism of how we are building our even mental model of how to think about a variety of these different layer ones that are emerging, that are already existing. And that particular narrative, I think, becomes even more nuanced and important with the latest rise of scalability solutions that oftentimes point to some of the existing flaws at kind of the underlying native layer, meaning it might not be as performant or it might actually not be as scalable as some of these dApps would desire. And it also has kind of a host of implications when it comes to new blockchains being launched today that maybe are taking much more app specific focus versus being kind of these monolithic offerings that try to kind of push that Big Ten narrative and really bring all the builders under one tent. So those are kind of just maybe some highlights of that model that we've been debating, honing on, and yeah, it's been very exciting to see how that model evolves as we are seeing more and more projects come to the market.
Yeah, it really resonated with me because I've always looked at Hedera that way, that eventually when some of these big enterprise use cases like Atma.io, the Coupon Bureau, Toko, as they start to come online and really add transactions to the network, we're going to see that fee revenue rise. It's fairly low right now, but as it increases, I think that's going to resonate with a lot of investors. And then from the infrastructure standpoint, we have the HBAR Foundation, and we have pretty much every few days, we have a new announcement of some kind of infrastructure that's being built around the Hedera network. So again, it really resonated with me, and I think you guys are on the right track. But along those lines, what does Arca think of the Hedera ecosystem?
Sure. Yeah. So I guess by virtue of me having spent a significant amount of time with the team, as well as in the ecosystem, I have been kind of the one doing a lot of what I would say kind of education and engagement with even our portfolio team on kind of Hedera and its moving pieces. I would say there are several elements that stand out for us as particularly kind of interesting as we move towards deeper and deeper into kind of the Web3 world. We're not in kind of Web5, despite kind of, I guess, what Jack Dorsey would make you believe, that there is still kind of long path to get there. But as we are advancing a variety of those different initiatives, as I'm going to mention in kind of culture, with the NFTs and gaming, in the decentralized finance, with ability to kind of offer financial services that don't necessarily go down because the bank is closed or is out of hours, or other whatever the reasons might be that you are not able to access your assets. So I would say as we are progressing on that arc, what is important for us is to have a great diversity of options for kind of the builders and projects that we like to back in the space. And so what I guess we like about Hedera today and where it's headed, because let's kind of be honest as well, and this is kind of to the point that you made, Brandon. When you're looking at just the pure fee generation today, it's not necessarily investable from kind of that perspective.
Sure.
It's still minuscule, but in many ways also by design, right? It's made to be very performant, very cheap to kind of scale these big mass applications on top. A lot of enterprise has been looking at Hedera precisely because of that reason. You can have a pretty nicely predictable cost base for whatever application you're trying to kind of bring onto Web3 rails. And so from that perspective, a lot of our views on Hedera and some of the pieces of the ecosystem is really trying to analyze kind of the future option value, whether it's the projects, the earliest projects that we are reviewing on our venture portfolio side that are looking to integrate some of the best qualities of Hedera, whether it's the HDS, the Hedera token service, whether it's existing fair transaction ordering on a Hedera consensus service, or also whether it's actually looking some of the earliest compatibilities on EVM that I know the team has been working very hard on shipping out. with each and every one of those, I think there are opportunities out there that we are very actively reviewing. And perhaps, again, this is more my personal opinion right now, but also based on some of the time that I've spent with respective leads in those two. The two areas that I'm particularly interested in diligencing, one is in kind of the NFTs and blockchain gaming. That is, without a doubt, a very important vertical to our venture fund. About a third of our portfolio sits firmly in kind of the infrastructure positions that are going to enable the development of those entertainment and media properties in kind of a tokenized format. And then second, nevertheless, a really important and interesting piece to me is the one where Hedera is making a push into sustainability, and not sustainability for kind of the just kind of a green check mark sake, but more so sustainability that is fully integrated into forms of accountability or on-chain accountability, and where there are solutions that are not only looking to kind of alleviate and address the carbon footprint, and as well as kind of the emerging carbon offset world, but doing it in such a way that is accountable, and where it's not pure greenwashing that we have been kind of accustomed to see over and over again, especially kind of in the existing disclosures and kind of the reports, many reports that have been written on a topic, but one that offers projects that mean to build these important sustainability solutions to now start settling on the ledger. And not only start settling on the ledger the actual trading activity of the carbon offsets and credits generated, but more importantly, link them and tie them to the productive assets that are generating those offsets. And to this day, that has been an incredibly difficult task, or actually a task that no one has done in a manner that would stand the scrutiny and true test. And so I'm very hopeful, and kind of based on my understanding on conversations with HBAR Foundation, with Wes, who's kind of leading this workshop work stream there, as well as the portfolio variety of different companies that are congregating on that vertical. I am getting quite optimistic and really do see an incredible compatibility with the way Hedera is structured as this kind of DLT layer, and the characteristic that it brings to the market that maybe other ledgers don't necessarily have today.
Yeah, there's a lot going on in that space. You know, as you mentioned, we have the Sustainable Impact Fund. There's so many parts and pieces. We really need to put together an infographic of how it all works together, where's Dovu, the Guardian, and all the other parts and pieces. And it's the same thing with gaming alone, let alone the rest of the metaverse space that's being built. You know, we have Vavel, we just heard about Lithos, we have Dropper that I just did an interview with. There's a lot of parts and pieces, as I mentioned there. I'd like to go a little bit more into the fees. You know, according to University College London study, Hedera is the most efficient layer 1 network. This is important from an environmental perspective, but also economically, allowing Hedera to have those fixed low fees you kind of mentioned, with 1/100th of a cent HBAR and HCS transaction, 1/10th of a cent base layer transaction for tokens like USDC and the Galaxy token CLXY. This is highly beneficial for startups and enterprise building on the network to control and forecast cost. You pretty much mentioned that. How does Arca evaluate these kinds of fundamental fee structures on these level 1 platforms?
Sure. Yeah, and fees is really where we spend a lot of our time, kind of parsing through not only the pro forma financial statements for a variety of different publicly traded protocols, but more importantly, looking at what do the investors care about, and in many ways, particularly looking with that kind of third generation distributed ledger projects, Hedera, of course, being one of them here, being performance scalable and really at a very low cost fees, it becomes almost a double-edged sword, right? And kind of the natural critics would say that because there is not sufficient amount of fee revenue being generated. There is kind of a subdued interest from kind of the traditional, I would say, crypto market participants. And this is, I would say, primarily the critique coming from the Ethereum camp and a number of kind of the EVM adjacent projects. And there is certain merit to it, but that also deserves thinking about a time frame. And that is where it becomes incredibly important to predefine what is kind of the time frame of an investment that one kind of looks at. If we are looking in a purely trading time frame of, say, 3 to 6 months or even less, you are really kind of behoove to look at what are the fees generated on chain at any given time. What is the user activity and the type of dApps that are kind of creating and putting that value on chain. Now, if you stretch out, and this is what I do all the time in our venture suite, looking at a much longer time horizon, many projects that actually don't even have a token that is live and trading yet. And those projects themselves are asking themselves, where should we go? Where should we kind of plant our flag, and which chain we should adopt? And with this comes kind of an important point to stress to them is like, what are you trying to kind of accomplish over the course of the first year, 3 years, 5-year time horizon? And so with the longer term view, there is a very real case to be made that actually the affordability of chains like Hedera specifically, you could scale up incredibly robust applications that have kind of the necessary throughput and kind of transaction volume, at which point in time you wouldn't be kind of held hostage by kind of the fee market,
Sure.
The on-chain fee market. And so there is I know a big subset of enterprises as well as some of these kind of long-term projects that are looking with that kind of key criteria in mind. But that is a very difficult challenge for many of the dApps that have to, pay their employees and make like a very real business use case. And so to those where we like to kind of recommend to the founders is primarily kind of focus on some of the real communities that you can scale up around your application, and then give really those communities a stake in kind of your business. And this
Sure.
is where primarily the element of tokens and tokenization comes into play. We see them fundamentally as one of the greatest bootstrapping mechanisms in kind of modern day capitalists. And having a cheap and efficient way to issue tokens into the market, tie those tokens directly to a form of utility that you're bringing to your community is incredibly important. And so having a performant technology that can do it at scale and at cost to these early projects is certainly one of the important criteria we recommend them to kind of look at and prioritize.
Yeah, it's especially with Hedera, it's all about fee revenue, the volume. We need large use cases with tremendous amounts of volume to make the Hedera network sustainable. But we'll broaden things out a bit. I know I've been getting you to talk a lot about Hedera, but what's Arca's overall outlook for the crypto market, and how are you positioning your funds?
Yeah, of course. So we've been through certainly a very interesting pullback, and quite frankly, if you really kind of trace back the pullback, it really didn't kind of stray far from what we've seen in especially kind of a tech growth stock since last November.
Sure.
They have been kind of of course hindsight is 2020, and writing, you could say that writing was on the wall, where particularly crypto still and digital assets still very much reside in kind of the risk on assets.
Mm-hmm.
Whenever there is any form of liquidity crunch or pullback, those are the markets that trade 24/7. They're not limited by what you would see in kind of your TradFi world, certain limits, such as 9 to 5, kind of trading and operating hours of withdrawals. Here, the investors have access to immediate liquidity. And so, unsurprising to everyone, there have been quite a lot of exchanges and DEXs that have supported investors kind of coming and running for that liquidity. Now, events that definitely kind of catalyzed the recent price action and have kind of caused probably one of the most depressing market sentiment that I recall ever since joining this space in kind of 2016. That I think had to do a little bit more with some of the exuberance that built up in the system over the course of last 18 months. And really kind of since the start of the last rally, and you could always almost take it 2 years back now to DeFi summer. I can't even believe it's been 2 years. And so to that end, what we have seen, especially with the collapse of Terra Luna ecosystem and really $50 billion ecosystem evaporating almost overnight, we as an industry and many in the industry have kind of prematurely celebrated the resilience of the ecosystem a little bit prematurely. I really recall, within the week of the Terra Luna collapse, many really embracing the fact that, well, we are resilient. The liquidations work, DeFi work tremendously well. And to this day, actually, I would argue actually is one of the better parts of the ecosystem that is working, despite kind of where the sentiment might be.
Yeah.
And so with that in mind, unfortunately, as that water was going out, as kind of the old Warren Buffett adage goes, you start actually see who is swimming naked. And the second order effects, now kind of 3-4 weeks in that postmortem, are only starting to kind of rear its ugly head and play out. And so last week's events of Free Arrow Capital effectively kind of defaulting on a lot of its loan obligations is just kind of the latest of the second order effects that many of us here at Arca expected, seeing kind of the implosion of Terra Luna. So from the perspective of positioning, we really like to, and I'll kind of talk you maybe through starting from the liquid book and then going more into our private book. On the liquid book side, we really think that this is very much kind of flight to quality moment, where one looks at some of the top quality leaders across the verticals that we kind of closely follow, whether it's the DEXs, whether it's the aggregators, whether it's the NFT platforms, whether it's the social token projects, taking an incredibly long and hard look as to what makes sense, goes to kind of our earlier point, what are the fees that these ecosystems have been able to generate and sustain, and how is the overall market, so the adjacent token, being priced or maybe mispriced with relation to the fees that we are seeing. So that is kind of an important exercise that we've been undertaking effectively since the start of a year, looking at a book of fewer but maybe more concentrated names that we like to back, and then going extremely deep on those, whether it's working with the projects directly or whether it's working with some of these springing up ecosystems. To us, that is particularly kind of interesting element of being this long-term investor that is really trying to make the best of our not only fiduciary responsibilities to our limited partners, but more importantly, also guide some of the founding teams and projects as to some of the ideas that we see might be worthwhile pursuing. And so that is kind of on the liquid book. On the private book, we really do like, and there's almost a kind of constant tension, even during our investment committees, when I kept banging a table, waiting for the bear market since we launched the fund in October, to effectively bring back a little bit more rationality to some of the valuations that have tremendously kind of crept up over the last kind of even 6-7 months prior. And so bringing in more of a mindset also from the founders that are here to build for a long term. And what that means is kind of several elements. One, not only kind of going first and foremost and optimizing for kind of the product market fit and being laser focused on your go-to-market offering, and building yourself, actually giving yourself the room to grow, versus kind of coming into the marketplace, raising at just like exorbitant valuation, and then setting yourself on the back foot whenever there is a pullback in the market, like we're seeing right now, to grow into that valuation. I would rather back a team that has a great idea, some early level validation of that idea, perhaps take on a smaller valuation entry point, align and kind of coalesce early stage investors, and then truly execute and over deliver on the product and the mission and the vision. And then sky is truly the limit. And I think what we'll see in this kind of bear market is spotlight into the teams that persist, persevere, and really build kind of long-lasting businesses. And when you are kind of looking back, and this is not just even crypto specific, as kind of the legendary Bill Gurley would say, as you look back at all of tech, some of the iconic brands that we kind of grew up, learned to love, and even now in Web3, all were kind of risen or were born in out of kind of the ashes of the great crisis or a great bear. And so to me, bear market is really almost like the gift that keeps on giving, because now we can truly find passionate founders that are building, they're here to stay and are not here to kind of moon and kind of leave as soon as kind of they reach their moon goals.
Sure.
So yeah, here for the builders and to back builders.
Yeah, I think the cream's going to rise during this bear market for sure. So you mentioned some of these high-profile issues we've had, with Terra Luna and Celsius, and it's going to have practical and regulatory implications for the space. What do you think the long-term effects are going to be from some of the fallout you mentioned?
Yeah, there are several, and really some I would categorize as existential level threat to crypto, to digital assets. And some perhaps the less benign but necessary pain and kind of short term, if we are to kind of develop that scar tissue and remain kind of emerge stronger out of bear. So I would say perhaps one that I do find existential level and is element of what has been happening with some of the recent events to retail. And retail that has been just entering or starting to really enter this ecosystem in a meaningful, scalable way. And I don't mean kind of ourselves, the crypto and Web3 natives. I really mean kind of the net new user that we're all hoping will kind of finally get here and finally arrive, the kind of proverbial next 100 million users. As we'll started actually seeing these early trickle of those millions coming to the space at literally top of the market. And so to me, one of the unfortunate elements of some of these events surrounding Terra Luna, Anchor, of course, very popular yielding protocol that really hurt a lot of small retail investors. That's quite frankly not being said enough. And I think that's the element that even here in the US, with kind of the recent news of lenders such as Celsius, kind of halting withdrawals, that's kind of another element that I would say is putting a little bit of hamper on kind of the net new user coming back or remaining even in that ecosystem for much longer. So I would say there are ways to address it, and there are several names out there, several projects that are doing everything kind of in their power to address it. But some of that early damage has been done, and we are kind of seeing it in kind of the flows, whether it's across the centralized exchanges. Some of them already report their financials in their disclosures, but others very much kind of even anecdotally talking about a major kind of bleeding of the retail leaving and departing the system. And so crypto and digital assets markets, as to traditional markets, are really always hanging kind of that very fine balance between the retail as well as institutional. Really, they're not, and that balance kind of is not very healthy when you primarily have kind of the institutionals and missing the retail component. So I would say we still have a long way to regain the trust and bring back that net new $100 million users into the ecosystem. How do we do it? Well, there are several ways. For starters, much bigger focus on transparency and disclosures, whether it's the proof of reserves or whether it's the actual disclosures on how are those funds being used on the back end to generate your yields. Very few providers out there, if any, have actually come out and disclosed that. And I don't mean kind of like a quarterly disclosure, but more importantly, a much more dynamic disclosures. And to me, that has been also one of the big pain of navigating investing in this space, that although everything is on chain, one can theoretically assign or address your risk management parameters and understanding kind of the counterparty risk. But the reality is that tagging is not perfect. There are mistakes, and those mistakes unfortunately balloon when wallets are mislabeled and when certain parties are kind of misidentified. So I think we can do much better on the transparency. We can do much better on investor education. I think that is, we as and this is kind of the collective, we as a sector have a much better job to do in kind of this cycle, to not only come out with good and educational resources such as Hedera Forum, such as many different projects actually come out with the engagement, but also engage in a debate, with other protocols, with other funds. You really have that kind of debate and have that in the open versus, I guess, trolling or on crypto Twitter, which is kind of as entertaining as it is, not necessarily adding to kind of a raising the level of comfort from kind of retail. So enough on kind of the topic of retail. I would say on the second order effect that I think you were kind of alluding in your question, regulatory front. Here we are going to see a very interesting action over the course of next weeks, months, coming out of kind of the regulatory alphabet soup of different agencies, with either certain indictments or actually charges brought to certain founders and teams that have truly misappropriated broken laws.
Sure.
And many laws at that. And so that element is incredibly important. And this is kind of to the scar tissue, that comment that I made earlier, to effectively cleanse the space and system from actors and agents that have not been acting in a good faith. And while in a bull market, you might get away with financial misconduct and misappropriation and breaking these laws because everything is going up, we're mooning. That strategy does not work in a bear market.
Sure.
And so I do see it as a point where nature will heal by kind of naturally swinging back kind of the pendulum and bringing some of those bad actors to justice. Now, there is, of course, element where the pendulum could swing to the extreme. Regulators could potentially stifle some of the innovation that is currently ongoing, or push certain projects offshore, and push them out of kind of the realm of a regulator. So I certainly am hoping for the best, but preparing for worst, I guess, is what one can only do, being kind of at the whim of current agencies and current kind of powers that be. And always exercise best judgment. I think it's the playbook as old as really invention of credit, which is kind of the oldest financial instrument out there. And so being kind of cognizant of your assets and liabilities and counterparty risk is always paramount, and doing your diligence, doing your own research. That's kind of the meme that we like to kind of repeat left and right, but it's still kind of, I find it mind-boggling that still so few people do, even
Sure.
kind of in a professional investor seat. So yeah, I would say regulation and kind of retail are probably the two that we are very closely watching as we kind of navigate.
Yeah, makes sense. So let's widen the lens one more time. There's pretty strong winds in the economic and the monetary fronts. What are your thoughts on the macro environment?
Sure. Can't escape macro when you're in digital assets. It seems like we have kind of almost a perfect storm of an environment. Not only the Fed is in many ways kind of forced to remove some of the demand from the market before we get any signs of relief. So continuing kind of raising the rates. But more importantly, what it does and kind of the implication for kind of the broader technology and then kind of adjacent to it, of course, digital assets. We are not out of the woods yet. I think is kind of the stage that I would kind of describe we are finding ourselves in.
Sure.
Continuing with kind of the narrative that we are hearing, not only from the Fed, but also some of the economic indicators, whether it's the inflation really being probably the highest that our generation ever experienced in our lifetime. So there's a lot of, I would say, unlearning that needs to happen from small retail investor trading the Robinhood account out of their PA, all the way to kind of institutional investors that have come of age in historically lowest inflation rate and environment. And so that unlearning, takes several forms. Some will adjust very fast into kind of that new normal paradigm of very different public market valuations and very different kind of token and project valuations than you were kind of accustomed in the last cycle. So I would say what is also kind of added the further complexity, and I don't want to, of course, downplay it, but it certainly has important commodities implications, is the conflict and the very real war going on right now, still going in Ukraine, that will, quite frankly, and someone as has a family in Poland, awfully close to the area of conflict, will get incredibly affected going into the winter, and the energy crisis that is just looming on the horizon. So many of the scares of the kind of global economic landscape not looking to get abated anytime soon. And if anything, expecting kind of a much bigger pain in kind of the months to come. So what can we do, right? I guess is the last and question in everyone's mind. And really, fundamentally, it really is time to kind of position yourselves accordingly, whether it's having liquidity, and this is kind of what I open with. It just kind of, it's all about survival. It's about surviving through the bear market, having a good position, cash-wise, having a very good burn management, whether it's your personal family budget or whether you're a project that is launching or has already launched. Being able to understand your runway and unit economics, now is kind of the time to get very real and very fast. And two, being incredibly focused on delivering value, whether it's your customers, whether it's kind of the end receiver of kind of your product. We are really going to see organizations rise to the top that are kind of putting a client first and foremost, because those are kind of the times where you develop a lot of loyalty. Whether you are, Amazon Prime that has incredible following, given kind of their customer service and their customer experience, or whether you are an investor that kind of always has their founders back and is willing to kind of spend their time. These are kind of the times when these kind of features and characteristics raise to the top, and brands are made, but also many brands are lost. And so that is kind of the natural cycle of events where the strongest and fittest will survive, And I'm just hoping that, yeah, we'll not only be in this camp, but more importantly, we'll kind of emerge much stronger with effectively a great cohort of founders and projects that we back here at Arca. But more importantly, we'll have kind of the good actors coming out in crypto that can take us further, can take us to kind of that next 100 million, next billion users, because yeah, there's a whole world out there to onboard, and we just need kind of the best soldiers really on the ground to pull it off.
That's right. That's right. So I know we had a certain amount of time allocated here. Do you have time for a few more questions?
Yeah, of course.
Okay. All right. So the first one, the inventor of Hashgraph, Lehman Baird, also the founder of Hedera, he says the world's going to be tokenized. What are your thoughts on, tokenized securities, digital twins, supply chains using NFTs, and so on?
Yeah, of course. I fully subscribe to the view that I see kind of the world getting tokenized. It really is a foundational technology that one could say almost kind of genie escaped the bottle. And I really don't think that fundamentally there is a way to kind of go back and put it back. Just the sheer level of kind of efficiency, access, and distribution that it offers is unparalleled to kind of even some of the earlier bootstrapping techniques that we have seen successfully in Web 2. I would say that with some of the segments of the economy that you have mentioned, there's going to be foundationally very different timelines to how this tokenization will come about. And I have no qualms that some perhaps much more complex elements, such as securities or kind of real assets, to put them on chain, will take much further coordination efforts than launching perhaps a loyalty token for Starbucks, which is our CIO's one of his favorite analogies of kind of Starbucks effectively coming out with a token that will not only kind of represent the loyalty points that you currently have, but will give you an ability to share in the brand and in brand building and becoming kind of a true ambassador to that brand. So to that end, on supply chains, similarly, I would say that there are a few more elements that one has to bridge, primarily the physical digital twin. I don't really know a single project or protocol that was able to effectively solve for a very common problem in supply chains, tracing, which is kind of the garbage in and garbage out, and tying physical properties to kind of the digital representation and making sure that chain of custody is honored. Similarly with securities, one element that we're working very hard at Arca Labs on, and this is perhaps part of a business that I haven't mentioned, it's our kind of internal moonshot laboratory where we are taking on some of these very real assets problems and structuring tokenization mechanism frameworks that will help bring those and usher these assets into 21st century. And the reason why it is part of kind of the Arca Labs is that specifically there are many different stakeholders that are necessary to pull this off. Of course, SEC, the regulators, are a big element here. Them agreeing to a certain framework of how these instruments will get treated takes time. Similarly, the counterparties that we are bringing, the custodians, the effectively data providers. Variety of those different building pieces are being built in real time, but it will take a little while before it all gets set and will kind of ossify and kind of solidify into more of a kind of usable format. And so, no doubt, tokenization is coming. It's just kind of a matter of when and not if. And there are definitely certain elements of this frontier that we are focusing on right now, even with our venture fund, which has kind of the 5 to 7 year window, where we see certain pieces of that tokenization kind of realizing coming to fruition much earlier than others. But fundamentally in agreement there.
Yeah, absolutely. And it is going to be a long road. You know, we heard about Atmaio from Avery Dennison well over a year ago, and it's just going to be coming to fruition this summer, and it's still going to be a proof of concept. So there is a long road there. So the last thing I wanted to ask you is we'll leave on a high note. What are you most excited about the crypto space, and where do you see the most growth?
Absolutely. I am most excited about a lot of the building pieces that still are missing to kind of bring to fruition some of the vision of across the verticals that we've mentioned even on this call here. But the elements that I am looking forward to the most, and you kind of look at the three different buckets of our own portfolio in the venture sleeve, they I think represent very well our own kind of thesis of how certain pieces of this economy might play out. And this is of course thesis that we are always prepared to adjust and tweak and modify. But one element that I am personally very excited about is, and didn't necessarily see it coming even 2 years ago, is how culture is seeing, how culture is getting tokenized, and not kind of in kind of the crude monetization layer, which often gets kind of derided for when you talk about NFTs, when you talk about blockchain gaming, really very common vectors of attack from kind of the more traditional gamers or art curators, art collectors. But more importantly, I'm very excited about the tokenization that is helping to coalesce and bring some of the communities behind these projects. And to me, a lot of the tooling that is still required to make it much more of an efficient community building are the pieces that I look out for the most. So anything that has to do with on-chain data querying and analytics. Foundationally, as I've mentioned, we need a much better way to not only label, but be able to showcase the transparency, whether it's vis-a-vis some of the regulators, but mostly kind of the customers and users, to showcase them that indeed certain pools that you're willing to access in DeFi are actually safe and have been de-risked. Here is a number of audits that we have conducted on the code base, and here is kind of the team behind it. So there are a variety of different ways to help de-risk this value prop. And so I would say another element that we are looking forward to is blockchain gaming. And this is kind of particularly interesting to us as Arca, given that we have been one of the earliest investors in Sky Mavis and have really gone through the entire arc of a journey with Axie Infinity, from kind of the doldrums of the last bear market all the way to its peak and height to where we are today. And there are certainly lessons learned. One lesson that we have definitely drawn out is that the parameters of blockchain gaming are incredibly empowering to several different stakeholders that are important there. Not only game developers, but also gamers themselves, getting a stake in kind of the ecosystems, in the time that they're committing, in the way they are engaging with other gamers and the game creators. So our long-term thesis is that we are seeing gaming to a large extent, and NFTs in the bucket as well, is almost like a tip of a spear that will take us out of this current existing bear market in a hopefully not too distant future. But those also take time. And so this is, I think, the element that doesn't get enough appreciation right now, both from critics and advocates alike, is that when you're looking at kind of a traditional game cycle or any even project time developer, you're looking at 3+ years before it ships out. As someone that used to game before I became a dad, I remember waiting for certain titles and then dealing with some of those delays. Some delays taking well over a year, but that wait being ultimately worth the while. And so where I find ourselves, particularly right now, I really am hoping and looking forward to some of the alignment in terms of the cycle of the game development, as well as where we are in the bear market, with all of the kind of noise leaving the space and the distraction leaving the space. I want the best teams in this in this vertical to be focused on building and shipping out, and not getting kind of distracted by certain price action or by certain needs or kind of voices from kind of the community calling for yet another NFT drop. I think there are kind of foundationally very important elements that these projects and teams can do. So that's kind of blockchain gaming NFT infrastructure. On DeFi, I really do think that DeFi is not dead. Even many would like to kind of sign yet another or write yet another obituary for this space. I do admit, and not afraid to admit, that indeed a lot of that kind of initial craze of retail coming in did get burned, and that is not kind of a light manner. But I believe there is a learning that is currently taking place. Majority of the projects that I'm talking in kind of the DeFi vertical are already looking at much better, more native compliance tooling that is actually compliant also with these open permissionless networks. Maybe not know your customer, but actually know your pool, or ability to innovate on ZK rollups, and ability to actually protect the identity of your counterparty without revealing kind of the commercially sensitive information, but just kind of the necessary information to execute the trade. So many of those elements, very excited about how they are getting integrated for kind of the next wave. And then finally, not the least, and I know this is a topic that has been close to the hearts of the Hedera community, identity and decentralized identity. This is the element that has been, quite frankly, a holy grail to so many applications that we look at. Haven't seen any team quite yet to crack it, but whoever does and does it first, really the vast majority of the opportunities will kind of open up, because that's kind of the element that will bring us to kind of a truly decentralized environment that we're all here to build and invest and back. So that is that's kind of, I would say, the landscape of opportunities that I'm excited about.
Michal, you have been super thorough on each one of your answers. I really appreciate the time you've taken, and I hope we can get you back before too long.
Thank you so much, Brandon, and good luck to everyone in the Hedera community. Our DMs are always open. I'm very excited to hear about some of the new projects that are cooking up across all the verticals, and even for verticals or projects that I haven't mentioned that are yet to be dreamed up. Please don't hesitate to reach out in any of my socials.